Algonquin Power and Utilities Corp. officially missed consensus on both the top and bottom lines for their Q2 2026 earnings.
Right.
Second quarter adjusted EPS came in at 4 cents, so that's missing the 5-cent analyst estimate, and it remained flat year over year.
Yeah, and GAAP net EPS was just a single penny.
Literally 1 penny, and revenue hit $543.9 million, so that missed the consensus estimate by roughly 1.5%.
But despite that double miss, management threw a massive curveball.
Yeah, they did.
They maintained their full year 2026 adjusted EPS guidance of 35 to 37 cents.
Right, and their 2027 guidance of 38 to 42 cents.
Exactly. Even though the stock reacted negatively right out of the gate, I mean, it dropped over 2% in pre-market trading to around $7.88.
Which keeps it well below major moving averages. I mean, technical indicators were flashing sell signals all morning.
For sure.
Okay, let's unpack this. Today, we're taking a deep dive into Algonquin's Q2 earnings reports, some analyst notes, and management commentary to figure out if this is a sinking ship or, a brilliant turnaround story.
Right, because on the surface, a double miss looks incredibly bad.
It looks awful. But looking investors in the eye and reaffirming the 2026 and 2027 guidance, that suggests management sees something the current quarter's numbers just aren't showing you.
Yeah.
So why remain so confident when the Q2 numbers are clearly lagging?
Well, to understand that confidence, you really have to look past those consolidated headline numbers. You have to diagnose exactly where the earnings leaked this quarter.
Right.
Because when you lift the hood and look at the segment performance, the narrative gets significantly more complicated.
Definitely. Let's get into GAAP net EPS.
Yeah, so GAAP net EPS, which is, the strictest by-the-book accounting measure, it didn't just miss. The net earnings plunged 66.9% year over year, down to $4.9 million.
Oh, wow.
Yeah, and even when you smooth out the accounting quirks, adjusted net earnings still fell 13.1% to $29.2 million.
So the hull of this ship definitely took on water.
Absolutely.
And when we look at the core business, the regulated services group, which is, it's the entire identity of the company now that they've transitioned to a pure play utility.
Right.
Net earnings there dropped to $30 million from $43.9 million a year ago.
Which is a huge haircut for the main engine of the business.
It is, even though revenue for the group actually ticked up slightly to $517.3 million.
Driven by electric, gas, and water distribution, yeah.
Exactly. So electric was $306.9 million, gas was $107.2 million, and water was $103.2 million.
And the hydro group also took a hit.
Yeah, that fell to $3.1 million from $8.9 million.
Plus, the corporate group posted a net loss of $28.2 million.
So the leak isn't isolated, it's happening across the entire board.
Yeah, but what's fascinating here is the why behind that margin compression.
Okay, lay it out for us.
It wasn't necessarily a sudden failure of their basic operations. The decline was driven heavily by the macroeconomic environment. Specifically, the cost of capital.
Right, because utilities are inherently capital intensive.
Exactly. They carry massive amounts of debt to build power plants and lay pipes. And servicing that debt is simply more expensive right now with higher interest rates.
Yeah, that makes sense.
You also have slightly higher operating expenses. And crucially, a very tough year-over-year comparison. Management pointed out that Q2 2025 featured non-recurring favorable items.
Right.
So the baseline they're being measured against this quarter was artificially inflated by one-offs last year.
It's like trying to beat your best golf score when you've suddenly got a massive headwind.
That's exactly it.
You've got higher interest rates pushing against you, and you're comparing your current score to a round last year where you got a few lucky bounces that just aren't repeating.
Yeah, it makes the current core operations look far worse than they might actually be.
But, that headwind doesn't account for the California wildfire charge, which was a specific, really heavy blow this quarter.
Oh, totally. The GAAP numbers were dragged down significantly by a $17.2 million regulatory asset write-down.
Yikes.
Yeah, this stems from a proposed decision on the 2020 Mountain View fire in California. It's part of what's known as the WEMA proceeding.
Right, the WEMA proceeding. So how does that actually work on the balance sheet?
Okay, to explain the mechanics here, Algonquin had recorded a certain amount of expected recovery on their balance sheet. They essentially assumed the regulators would let them pass those wildfire costs on to customers.
Sure.
But the California regulator proposed a framework that only allows for 75% recovery of those recorded costs.
Oh, I see.
Yeah, so when a regulator officially says you aren't getting all that money back, accounting rules force you to write down the value of that asset immediately.
Right, so that missing 25% just vaporizes from the balance sheet.
Exactly, and it hits the GAAP earnings all at once.
I have to push back a little here, though.
Okay, go for it.
Management points to timing, tougher year-over-year comps, and this specific California write-down to explain the leak.
Yeah.
But when you strip all of those excuses away, you still have rising operating expenses in the core regulated services group.
That is true.
So is this really just a string of bad timing and regulatory bad luck? Or is there a fundamental weakness in their ability to control costs in a high inflation environment?
Honestly, it's a completely fair question, and it's exactly what the market was pricing in with that pre-market drop.
Right.
The pressure on operating margins and cost control is a real, tangible risk. But this brings us directly to how Algonquin plans to plug the leak.
By going to regulators.
Exactly. For a regulated utility, you don't necessarily fix your margins just by slashing your workforce or cutting operational corners. You fix them by getting the state regulators to legally agree that your costs have gone up and then allowing you to charge ratepayers more.
Which is the regulatory pipeline.
Right. They're aggressively pursuing regulatory wins to force their revenue to catch up to these inflated expenses.
That's the infamous regulatory lag.
Yeah.
You have to spend the money today to maintain the grid, deal with inflation, or upgrade infrastructure. And then you have to wait months, or in the case of the Mountain View fire, literally years, for the state regulator to let you raise rates to recover those costs.
Which creates a brutal squeeze on current earnings.
A really brutal squeeze. So let's look at the pipeline they're banking on to hit that reaffirmed guidance.
Let's do it.
So in Missouri, they just achieved an $8.8 million rate approval. And importantly, they secured CDU treatment for a planned 250-megawatt gas generation project.
Yeah, that CDU approval construction work in progress in Missouri is a massive operational victory for their cash flow.
Explain why CDU is so important for them right now.
Normally, a utility spends hundreds of millions building a new power plant, right? They're taking on debt and paying interest the entire time. But they cannot earn a single cent of return on it until the plant is fully operational and pushing power to customers.
Which can take years.
Exactly. CWIP changes the game. It allows the utility to start recovering those financing costs from customers while the plant is still essentially a dirt lot being excavated.
Oh, wow. So it's basically paying them while they build.
Right. It drastically reduces the financing strain on the company during the most capital-intensive phase of the project.
That's a huge win. Then you have California, where despite that $17.2 million write-down we mentioned earlier, the proposed decision still allows them to recover the other 75% of recorded costs from the 2020 wildfire.
Which translates to a cash injection of about $58.1 million.
That's not small.
Yeah.
And over in New York, they're currently seeking a $38.1 million revenue adjustment.
So you start adding up Missouri, California, and New York, and the revenue catch-up that management is modeling for the back half of the year and into 2027 becomes very visible.
It really does.
Yeah, that regulatory catch-up is the entire foundation holding up their maintained guidance. The current earnings squeeze is essentially a timing mismatch.
Just a lag.
Exactly. The expenses have already hit the income statement, but the corresponding rate increases haven't fully materialized on the revenue side yet.
Okay, so as these rate cases get officially approved and implemented across their territories, the revenue line will step up to match the higher expense baseline.
Yep. Furthermore, they're forecasting $0.8 billion in capital expenditures just for 2026.
Almost $1 billion.
And a massive aggregate of $3.2 billion planned between 2026 and 2028.
That is a lot of capital going into the ground.
It is, but by pushing all that capital into the ground, they expect to drive a compound annual growth rate in their rate base of 5 to 6% all the way through 2028.
Here's where it gets really interesting, though.
Okay.
A 5 to 6% rate base CAGR is a solid, dependable growth story for a utility.
Sure is.
But if they're planning to inject $3.2 billion into capital expenditures over the next 3 years, where exactly is that cash coming from?
That is the million-dollar question.
Right. Because we just established they're facing an earnings squeeze, net earnings are down, and they have higher financing costs. You don't just find $3.2 billion in the sofa cushions.
No, you do not.
So this forces us to look really closely at the health of their balance sheet.
And you've hit on the central tension of the entire Algonquin thesis right now.
Yeah.
They're a capital-hungry business operating in an environment where capital is punishingly expensive. And their balance sheet is frankly showing some distinct stress
He
fractures.
really is.
To fund that $3.2 billion, they have to navigate a very tight financial window.
Let's lay out those balance sheet realities for you listening. Algonquin currently maintains a BBB investment grade rating, which is critical for keeping their borrowing costs manageable.
Absolutely critical.
But their trailing FFO to debt, that's funds from operations to debt, which is the key ratio of cash flow to debt load that rating agencies just obsess over, that ratio fell from 12.9% down to 11.9%. Right. Now, 11.9% might not sound like a huge drop on paper, but it leaves a very narrow cushion above S&P's 11% downgrade threshold.
Yeah, they are just 90 basis points, so less than 1% above the trigger.
Exactly. If they dip below 11%, they risk losing that BBB rating, which would make all future borrowing significantly more expensive.
If we connect this to the bigger picture, you can see the precarious nature of this setup. Algonquin is walking a tightrope without a net.
Yep.
Management has explicitly stated they do not expect to issue any new equity through 2027.
Which makes sense. They aren't going to sell stock to raise this cash because the stock price is currently depressed.
Right, issuing shares down here would be terribly dilutive to current shareholders.
So they have to rely entirely on debt and whatever internally generated cash flow they can muster.
And to manage their current debt load, they recently priced $1.15 billion in senior notes just to refinance existing obligations.
Just to refinance.
Yeah.
Operating with this kind of constraint is like flying a plane just a few hundred feet above the tree line.
That's a great way to put it.
Right. It's perfectly fine as long as you maintain speed and there's absolutely no sudden downdraft. But you have zero altitude to recover if something goes wrong.
Zero.
So what happens if another unexpected cost hits before these rate cases fully materialize? What if there's an unfavorable regulatory ruling, another severe weather event, or, I don't know, further wildfire liabilities popping up in their service territories?
The math gets very ugly very quickly if they hit that downdraft.
Yeah.
With FFO to debt sitting just 90 basis points above the downgrade trigger, they have absolutely no margin for error.
None.
If an unexpected cost forces them to take on more emergency debt, the denominator in that ratio goes up.
Right.
And if earnings dip further and lower their funds from operations, the numerator goes down.
So either way, they get squeezed.
Either way, they could easily breach the 11% threshold. A credit downgrade would immediately increase their interest expense across the board.
Which further compresses the net earnings we were dissecting earlier.
Exactly. It creates a brutal negative feedback loop. Flawless execution on these rate cases is no longer just a growth strategy for Algonquin. It's a requirement for balance sheet survival.
So they're trapped between the absolute necessity to spend $3.2 billion to grow the rate base and the reality of a balance sheet that is stretched to its absolute limits.
Yep.
To relieve some of this suffocating financial pressure and perhaps reshape the market's narrative, Algonquin is pulling a major strategic lever for 2027.
Oh, yeah. They are targeting a U.S. redomiciliation.
Tell us about that.
Pending a shareholder vote in the first half of 2027, they plan to officially move their corporate domicile from Canada to the United States.
Okay.
And this isn't just a symbolic changing of the flag in the headquarters. There are hard financial and strategic mechanics driving this decision.
Let's hear the financial side first.
First, moving to the U.S. is expected to significantly reduce cross-border tax costs. Management estimates this will generate a recurring tax benefit of roughly 2 to 3 Canadian cents per share once it is fully effective.
2 to 3 cents per share might not sound like a game changer to a casual observer, but let's put that in context.
Yeah, please do.
When your adjusted EPS for the entire quarter was only 4 cents, a permanent structural reduction in tax leakage is a massive bottom line boost.
Massive. That is a direct way to plug the earnings leak we talked about earlier.
Absolutely. But there are also broader strategic benefits to this move, right?
Right. They want to improve capital market access and potentially support U.S. index inclusion.
This is big.
It really is. If you're domiciled in the U.S., you suddenly become eligible for a whole suite of passive indices and ETFs that currently are not allowed to hold a Canadian domiciled utility.
The mechanics of that index inclusion are incredibly powerful.
Very powerful.
Because when a company is added to a major U.S. index, every passive ETF that tracks that index is forced to buy the stock.
They have to?
Right. It doesn't matter if those fund managers think Algonquin's Q2 earnings were terrible or if they're worried about the FFO to debt ratio.
The algorithms simply execute the buy orders to mirror the index.
And that blind algorithmic buying puts a tremendous floor under the stock price and creates steady demand.
You can synthesize this entire redomiciliation move as the final puzzle piece in their multi-year transition.
Right, because Algonquin recently sold off their non-regulated renewable energy business to become a pure-play regulated utility.
Right. So moving the headquarters aligns their corporate structure with their primary operating footprint, since the vast majority of their utility assets are located in the U.S.
Makes total sense.
It makes them directly comparable to their U.S. utility peers and simplifies their story for U.S. investors.
So what does this all mean?
Good question.
I have to challenge this move from a purely operational standpoint.
Go for it.
Saving 2 to 3 cents a share on taxes is objectively great.
Yes, it is.
Getting forced buying from U.S. index funds will absolutely support the stock price.
Definitively.
But when push comes to shove, moving the corporate HQ doesn't actually fix the company's operational hurdles, does it? I mean, it doesn't magically lower the cost of a transformer.
Right.
It doesn't solve the FFO to debt crunch overnight. And it certainly doesn't make the California regulators any more lenient.
No, it doesn't.
So is this primarily just financial engineering designed to attract a different class of investor while distracting from the core operational squeeze?
You're entirely correct that redomiciling does not fix a broken utility pole any faster or change the fundamental regulatory math in New York or California.
Right.
The operational execution has to happen regardless of what country the C-suite is sitting in. However, dismissing it as purely a distraction ignores how deeply interconnected the finances and operations are.
Okay, fair enough.
That recurring tax benefit directly improves funds from operations. It puts real unencumbered cash back on the balance sheet, which incrementally helps defend that crucial FFO to debt ratio we were just worried about.
So it gives them a little more altitude above the tree line?
Exactly. Furthermore, by improving capital market access, if they ever do need to issue equity post-2027 to fund more infrastructure, a U.S. listing with index support likely gives them a much better valuation to do so.
Oh, I see.
The goal of this financial engineering is to solve the structural inefficiencies of the business so that management can focus their entire bandwidth on the operational ones.
That structural perspective makes a lot of sense. It buys them breathing room and finally aligns the corporate shell with the actual assets in the ground.
Exactly.
The reality for you looking at Algonquin today is that you are evaluating a company mid-surgery.
That is a perfect way to describe it.
Yeah, the dramatic transition to a pure-play utility is done. But the financial optimization of that transition, pushing through the rate cases, refinancing the debt, executing the redomiciliation, that's all still playing out in real time, quarter by quarter.
Which requires patience from the market.
And patience is hard to come by.
Unfortunately, patience is something the market is often in very short supply of, especially when headline earnings miss estimates and technical indicators start flashing sell signals.
Yep.
But if you look closely at that maintained guidance, management is essentially telling the market, judge us on the 2026 and 2027 run rate when the rate cases catch up, not on the noise of a single transitional quarter.
I think that's the key takeaway there. Now, before we wrap up this analysis, there is a forward-looking wild card found deep in the source material that you really need to keep on your radar.
Oh, the tariff.
Yes. Algonquin quietly noted that they are preparing a large load tariff in Missouri.
Right.
Now, why does a specific electricity tariff in Missouri matter to the broader thesis? Because it's specifically designed to facilitate future data center or heavy industrial demand.
This is huge.
Management didn't disclose any specific customer pipeline or signed load commitments yet, but you have to read between the lines here.
For sure.
We are in the absolute middle of a massive AI and data center energy boom, and these facilities require unprecedented amounts of uninterrupted baseload power.
They're just power-hungry beasts.
Could this be the ultimate catalyst? I mean, if Algonquin can secure major data center contracts in a constructive regulatory environment like Missouri, it could fundamentally shift their entire demand profile.
It really could. It would accelerate their rate-based growth far beyond that 5 to 6% projection we talked about earlier.
Right.
And it could permanently solve the growth bottlenecks we've been dissecting today.
It's a speculative thought, but in the utility sector right now, AI data center demand is the single biggest wild card on the board.
Without a doubt.
Make sure you hit follow on the show so you don't miss our daily earnings coverage as we continue to track how these companies navigate a very murky diagnostic landscape.